Welcome to Retirement Straight Talk with Paul and William, featuring award-winning financial advisor and former host of the Sunday Money Show, News Talk 1010, Paul Baraka, and his associate advisor, William Baraka. Creating and keeping wealth does not need to be complicated. Paul and William will cut through confusing and contradictory financial advice to give you the real facts to help you invest better and enjoy a worry-free retirement. The views and opinions expressed in this video may not necessarily reflect those of IPC Securities Corporation. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions.
Welcome, everyone, to episode 47 of Retirement Straight Talk with Paul and William. And welcome to all of you, either those of you who are watching us on our YouTube channel or through the various, or listening on one of the various streaming services. My name is Paul, and I'm here with my associate advisor, William. And today we're going to talk about something I think is misunderstood. In fact, I know is misunderstood, right? Well, and that is, what is a valuable use of your time when you sit down with your advisor for your regular semi-annual or whatever review meeting, right? And we're going to split this up into two parts for our listeners. The first part is talking about what things should be done to add value. And second part, we're going to talking about, the value of talking about specific stock selection. And you've got a lot of data on that, right, William?
Sure do.
So now the first thing, as you know, that I've been, I did radio for over 20 years and I saw all sorts of people. And I'd always ask people, what do you do with your advisor when you sit down with your review? And the common, almost all the time, by the way, it still shocks me. What the number of people, and probably more than 1,000 people, said, look, I sit down with my advisor, he pulls out a statement, we look at it, and he talks about the positions, or he or she talks about the position and says, well, let's maybe sell these and buy these, and here's why, and so forth. So, and that was the majority of what was talked about during the conversation on the review meeting. Now,
and by the way, Paul, it's easy to see why maybe some people are attracted to that. We've all heard, whether it's a friend, a family member, a colleague, whoever it is, someone who's proclaimed to made a killing on a stock, a couple stocks. So we're alert not only by those potential riches, but also just by the excitement. Like picking stocks is more fun than, buying a boring mutual fund or index fund,
yes,
whatever it is.
Oh, of course.
We're going to get into today more, is there value in doing that?
Yeah. And first thing I just wanted to mention too, more often than not, almost all the time, the advisor does not have a copy of the client's tax return, corporate financial statements, insurance policy, wills and powers of attorneys. But why don't we just compare that with when you visit your family doctor? Most people, you should go once a year and do a checkup. Well, I don't know about you, William, but me, when I come into the family doctor, he doesn't pull out the prescription pad right away and say, well, this is good for you and that's good for you. I mean, I imagine you're just the same thing. He says, well, maybe, let's go get some blood work done on you. Let's see what's going on. Let's check your blood levels. Maybe you need an x-ray or whatever other type of testing is needed. And then what are the types of things? My doctor anyway, he says, well, how's everything going? Any stress going on? Business, at home, family life? Let's look at your history. Let's see what's happened in the past there. And only after all of that information is reviewed does the doctor say, well, maybe this might be worthwhile for you, maybe that. And how much of that is the whole appointment, Will? I don't know. With me, it's just a couple of minutes. What about you?
I don't know. I've been remiss. I haven't seen a doctor in a while, but I know what you're talking about. I need to go for a checkup. But I certainly know in my past experience that they don't spend too much time talking about medication at the start. It's more just 5 minutes or so at the end after they find out what's going on with you.
Yeah, there's an old saying, by the way, and that's diagnosis before prognosis is malpractice. And I thought, you know what, there's a lot to compare between going to the doctor and going to your financial advisor. See, as far as I'm concerned anyway. And why don't we look first, if there's an organization called FP Canada, and that stands for Financial Planning Canada, and that's the organization that oversees the designation, the certified financial planning designation that both we have. And there's all sorts of requirements to hold that designation. And they say, you know, to do a proper job, here's what you need to do to be a financial advisor. You have to get to know a client intimately, them, their family, their business. You know, what are their attitudes? What are their values towards money and so forth? What are their goals? What's going on in their life from a tax perspective? You know, when do they want to retire? You have to understand what's changing in their lives all the time, because all their lives change. And according to FP Canada, you know, you should be doing a retirement plan or plans to achieve any goals. You should be looking at their tax situation. You should be looking at their estate situation, their wills, their power of attorneys, their risk management, or their insurance. Now, as I mentioned, when I was doing radio, I rarely met anyone whose advisor asked them for their tax returns, for, you know, their insurance policies and so forth. You know, I think it's kind of challenging.
I think that's new. Most people listening, they don't understand what a financial planner should do. They automatically revert to, they pick investments.
Yeah,
we do investment management for sure. It's a big part of what we do, but I think like you're getting to, there's a lot more that goes into it. So I think today we're going to talk about how much value is there to be provided. Maybe there is a lot of value by your advisor picking individual stocks, spending a lot of time in your meetings talking about individual stocks. So we're just going to dive into some data and see, does that make sense? Does that provide value to a lot of people? All right. So to do that, we're going to look at a few common strategies that we both heard, Paul, from talking to people, listening to other advisors and how they conduct their business, and look at some strategies and how they pick stocks to see, is there any basis in it? Again, can this provide value? And then we're going to look into the actual data to see how are some people doing, how are they fare against just buying an index fund and not spending as much time just picking individual stocks. Now, the first strategy, I mean, Paul, have you ever heard the strategy where whether it's a prospective client or talking to another advisor and listening to how they manage their own stock portfolio? Have you ever heard someone say, I just buy solid blue chip companies, I'm not worried about them?
A lot of people just buy solid blue chip dividend paying companies because they're going to do the best. Do they?
Yeah, I've heard the same thing. And I mean, there's a few problems with that. The first is that blue chip companies can be blue chip until they aren't
not
anymore.
They're not.
Like we spoke about on our last episode, General Electric, which for a while was the most solid of blue chip companies, isn't anymore. We've spoken about Blockbuster, Kodak, Sears, BlackBerry,
Polaroid.
All these seemingly once dominant companies that persisted for a very long time until just one day they weren't blue chip anymore. Another problem with that is it's not enough. I mean, the best company in the world can be a terrible investment. And for example, Microsoft. So Paul, if you bought Microsoft at the height of the tech bubble back in 2000, it would have taken you over 14 years just to break even on Microsoft stock.
And we hear that a lot. Oh, I've got this company. Look, it's a great company. It's a well-known name. Maybe you have their products in your home or your business. But yeah, things happen. I mean, we're talking this morning about, you know, you have the Magnificent Seven, they call them today, you know, all the technology shares. And I'm guessing, I don't know for sure, I'm guessing in 5 years, one or two or three of them might not be dominant anymore. And there'll be companies that we haven't heard of yet Maybe
But Paul,
AI
they could
companies.
still be dominant and still be a bad investment. During those 14
Yes.
years, Microsoft was still one of the biggest companies in the world. Almost everyone used their products and services, but the stock was just mispriced. So it was still a great company that everyone used, but the stock was mispriced. So it was a terrible investment. And
For
then, like you
14 years.
said, similarly, another strategy that people use, and this is a good segue into the next common strategy that people use, is just buying what's done well recently. So, like you were saying, the Magnificent Seven right now, those are the stocks
Just
that are
buy
doing
them.
really well right now, aren't they?
Yeah. Now, that's one of the biases. We've talked about this before, right, William? Recency bias, they call that. And we're all guilty of it, by the way, every single person listening, including you or me. And that is, yes, this has done great. And we think, oh, it's going to probably continue to do great, because we all think, as human beings, we all think that whatever trend is happening now will continue forever. It's human nature.
Yeah, I mean, some research on that quickly. Dimensional looked between 1927 and December 2022 in the US stock market, and it found that before joining the top 10 biggest market capitalization companies in the US, those companies in the previous 5 years averaged an over 20% return. In the next 5 years, after joining the biggest top 10 companies in the States, they averaged a negative 0.9% return. So
That's
buying just what's done well
astounding.
recently has historically not been a good strategy.
That's absolutely astounding. And the same thing goes whether you look at ETFs or mutual funds, where people say, "Oh, this mutual fund has done great. Look at the 5 year number. It's top of the heap. It's fantastic." But statistically, and we've seen this numerous times, the second 5 years after that, there's a much bigger chance they're going to be one of the losers. They're going to be well below normal type performance. And that is the data on that is pretty clear. Not always, there's always exceptions, of course, but the data is pretty clear that that happens more often than not.
Yep.
So you're right.
Now, another common strategy we hear from whether it's other advisors or prospective clients and how they manage their stock portfolio is they listen to stock analysts. There's these big investment banks and their stock analysts put out reports that say, buy this, buy that, sell that. And a lot of people put a lot of weight into those, don't they, Paul?
Well, yeah, boy. Let's go, because I have some interesting discussion on that. But yes, a lot of people put weight on that. And well, maybe I should talk about this right now. I'm going to read this because I want to make sure I got it right. Imagine two fund managers, manager A, manager B, and manager A picks and buys, purchases and sell selection based on a strategy. Now, manager B doesn't do that. He just picks his stock randomly, picks the whole market, basically throws darts at a dartboard. Well, most people would think that manager A, who has the process, will do better. But according to Princeton University professor Burton Michael, and I may be pronouncing it wrong, and he famously claimed in his best-selling book, A Random Walk Down Wall Street, that, and I'm quoting, blindfolded monkeys throwing darts at a newspaper's financial plays could select a portfolio that just does just as well. And they looked at over 2 million sells and 2.4 million buys made by institutional money managers between 2000 and 2016. So Warren Buffett's talked about the same thing, that, unless you are intimately involved with these companies, it's better, it's really hard to pick a winner.
Yeah,
You've heard that before.
Studies have shown, Paul, stock analysts, they're worse at picking stocks than just flipping a coin. They have less than a 50-50 chance of getting it right. Yeah. It also shows that, we just spoke about a common strategy of just buying what's done well recently. That's recency bias, like you said. And studies have shown that stock analysts, they're guilty of the same biases that everyone else is, and that
we all are.
Exactly. They all herd into what's doing well. For example, before we move on, during the tech bubble of the late 90s,
Yeah.
there was a ratio of between buy to sell recommendations by financial analysts for tech stocks of 100 to 1. So right before the bubble burst, 100 analysts were recommending to keep buying these overpriced tech stocks, which eventually burst, versus one on average who was recommending sell. So listening to stock analysts, putting much stock into what they say, probably not a recipe for success.
And the same thing when you're dealing with your financial advisor. I mean, look, what's your financial advisor? You may have a really good one, but your financial advisor does not do stock research. They spend their time on the phone or in person talking with their clients about their situation, learning more about them. They're not analyzing stocks. Now, they may go to their firm's stock analysts and pick them. But again, we talked about that, it's like flipping a coin. So now, did you have something else? You have something else there, and then I want to kind of help summarize this a bit.
Well, just lastly, and I think for all listeners, they kind of get where we're getting at here, and that stock picking is not a worthwhile endeavor probably for most people or financial advisors, not a good use of time because it's extremely hard. For example, Professor Hendrik Bessemeinder at the Arizona State University, he looked at the entire U.S. stock market from 1926. And what he found was that in that time, 58% of stocks failed to beat a treasury bill, which is a risk-free asset, a bond. Mm-hmm. So over half of stocks failed to beat just a risk-free asset, even though in that time period, U.S. stocks have created $35 trillion of wealth over and above treasury bills. But that $35 trillion came from just 4 companies. 4% of companies. So unless you're smart enough or lucky enough to pick those 4% of companies, you're at serious risk of not only just underperforming the index, but of actually having an absolute negative return on your investments. Pretty risky business.
Yeah. I mean, that's what I think, most people listening or watching are going to see this. We've talked before about how the statistics and the analysis is pretty crystal clear that passive investments over most time frames and most of the time outperform managed for the reasons that we talked about. So when this discussion today is talking about what's a good value of your time sitting in front of your advisor. And my suggestion is it's not talking about your portfolio.
Yeah.
You know what?
Maybe your friendly advisor is the exception to the rule, but chances are they aren't. And I'd be highly skeptical of any advisor whose main value proposition is their stock picking acumen.
Yeah. And how should they be adding value? Again, getting to know you more intimately, your family, your business, your thoughts on money, your tech, what's changed in your financial situation and what's likely to change in the future. Spending the time on those can add massive value.
In addition, Paul, to the other things that are proven to have demonstrated value for clients from advisors: tax planning, estate planning, retirement income planning, managing your behavioral biases that we talk about so much. These are all things that your advisor should be spending the majority of the time you speak with them about, not whether we should buy or sell ABC stock.
Absolutely, absolutely. So with that being said, I think we've summarized. It's kind of a short show today, William, but that's fine. I think we got across what we wanted to, what we think is important, and what is important for them to understand how they can create value with their own advisor. With that being said, we want to talk about our next podcast coming up. And by the way, thanks everyone for listening or watching. We hope we see you again soon. Next time, I'm going to be looking back at my 32 years in this business, and William's getting to be good, well experienced also. We're going to talk about at least 11 things that I've learned about money that I think can add real value to people's situations. So we'll talk about that on the next podcast.
Okay. Sounds good, Paul. Look forward to it. And thanks to everyone. Thanks for joining us today. If you like what you heard, please, it'd be a big favor to us. Just pass along to someone you know who you think
Absolutely.
might benefit from it as well. You can hear more from us on social media as well. You can follow both of us on LinkedIn, and I'm on X as well. I'll put the links to those in the show notes below. So thanks, everyone. Thanks, Paul. Thanks for joining us, and we'll chat in a couple weeks.
Cheers. Have a good day.
This podcast was brought to you by West End Wealth Planning, an award-winning wealth planning practice catering to small and medium-sized business owners and to those looking to create a worry-free retirement for themselves and their families. To learn more, go to westendwealth.com. Don't forget to rate this podcast and subscribe to Retirement Straight Talk with Paul and William by going to Apple Podcasts, Spotify, or wherever you find your podcasts.